Hey there YouTube, it's Jeff Perry with Must Be Nice Investments, and I'm coming at you on Friday night. Unfortunately, due to COVID-19, I've got nothing else better than to talk about real estate financing. So tonight we're coming at you with the conventional lending guidelines and how to meet those. So we'll jump right into this. First one first, bankruptcies. Do not have a bankruptcy on your record. If you can help it, ever. But for these rules, for the last 4 years, you got to have a clean record with no bankruptcies. Pay your debts. If you don't have to declare bankruptcy, don't do it, because you're not going to be able to get in this game or get back into it very easily. Next one, short sales, or what some people call a deed in lieu. Again, 4 years, you got to have a clean record there. A short sale, if you don't know, is that's when you sell your home for less money than you owe on it. The bank typically agrees to this. Let's say you owed 100 grand on a property. You just got upside down on it, whatever. They said, okay, we agree, you can go sell that for $90,000 and we'll let you out of it. That's a short sale. 4 years, none of those on your record. A deed in lieu, that's a little bit different. Under a deed of lieu or foreclosure, the borrower transfers the deed, the interest in a secured property to the lender. Okay, so that's probably a little less common, but again, short sales, bankruptcies, 4 years, keep those off your record. Same thing with foreclosures. None of those in the last 4 years. Guys, if you can help it, find a way to get bailed out. Keep your credit clean. No bankruptcies. If you got to get your buddy, your mom, dad, whoever, keep these off your record, because it really makes it hard for you to invest in real estate going forward if you have these on your record. Okay, next one is mortgage payments. They must be current in the last 12 months on any and all mortgages. So if you have 10 mortgages, make sure that all of them are current. All of them you've paid the bills on. You're keeping current on all those, and that shouldn't be an issue if you're getting ready to buy a house. You know if you've missed one, you've come on hard times in the last 12 months. So just know that it's 12 months is the rule. The next one we're going to talk about is debt to income. Must be less than 50%. If this is a rental property you're buying, make sure that you give the lender who will give you credit. Some lenders will not give you credit for having a tenant in there. And let's say you have another one, a tenant's coming out of that one that month, and you don't have a contract in place. They may not go to your tax returns. They may, to see if you're making money on that property. But a lot of times your tax returns, you may show a loss. So I would caution against that. At worst, you want your rental property on paper, tax paper, to show that it's breaking even. But that can work against you under debt to income. So debt to income, you make 100 grand. Say you get 100 grand of money coming in. You got 50 grand going out, or let's say 40 grand going out. If you plan to do 10,000 more out without a renter, that's going to be a problem. So manage that effectively. This number is also one that kind of moves up and down depending on the lender. So right now is at 50%. And if you can manage your finances that way, keep it under 50% and you should be just fine. Next one we got is employment. You got to have a job, man. You got to have money coming in, or they're not going to let you borrow money from themselves. So W-2 jobs are by far the easiest way to deal with this. And you must have 2 years of working history. A lot of times they're going to want to see that in the same industry. Okay, they're going to want to see that if you change jobs, you kind of had the same type of job, etc., same job title, or maybe in the same. You can change jobs. And I've bought houses, 3 months into a new job, but I've been working in the same industry for 15 years, etc. The underwriters are going to give you credit for having a good job history, especially in the same industry. If you're a business owner or a 1099 worker, you need to provide 2 years of tax returns with the profit, okay? And of course, that profit needs to be enough to meet the debt to income ratio. So you gotta be making enough money to cover any new debts and any of your current debts. If you've been in business a while and have a profitable business, you'll need to prove 1 year of income from that business. And I guess you do that. I don't have this problem right now, but I guess you would do that through a P&L statement or something like that. And then finally, last one we need to talk about is the K-1 income. This is a Schedule K-1 it's basically a tax document used to report income, losses, and dividends of owners or holders or shareholders, business partners in an S corporation. So these are pretty common in the multifamily game for large multifamily apartment syndication deals, etc. I'm on one of them. And a lot of times the K-1 is a pass-through. So it's a pass-through, the tax liabilities, etc. are on you. One thing that's cool about multifamily is you can depreciate, you can do a bonus depreciation and basically depreciate the entire asset in the first year, instead of with rental properties or single-family properties, you do it over the course of 27 years. So, but that doesn't hurt you in this case. It's just a paper loss. It's not going to go against you. And a lot of times lenders may not even ask you about your K1 income, etc., unless you bring it to them. Okay, so that wraps it up, guys. It's pretty easy on the conventional lending guidelines if you're getting into this. The biggest one to kind of keep a head on if you're planning long term, like maybe 2-3 properties down the road, think about that debt to income and whether or not you're going to cash flow, whether or not you're going to have tenants leaving a lease at a certain time when you're getting ready to close on another loan. Make sure you have money coming in on all the debts, on the other debts you have. So that's the biggest one to pay attention to, other than, hey, got to have a job, right? So anyways, guys, appreciate you joining me tonight. Had a lot of fun doing this. And please, if you like these videos, there's going to be more in this finance series. Hit like on this video and let me know that. And if you would, please subscribe as well.